I do want to get your thoughts on the upcoming earnings season writ large here, about your general expectations for how some of these companies are going to handle a much different environment than where they were a year ago.
You know, the amount of COVID stimulus was really unbelievable. In 1 year, March of 2020 to March of 21, $5.7 trillion, $5,700 billion was appropriated. And when you have that much fiscal stimulus offsetting the private sector contraction and offsetting it, overfilling it, you got a powerful rebound in earnings. In the last two recessions, after the tech wreck in 2000 and after the financial crisis in 08, it took 3 years for earnings to rebound above its long-term trend. This year it did it in 2021. So our estimate is that as the Purchasing Manager Index for manufacturing, which is a really good forward indicator of earnings growth, as that falls sharply in the middle quarters of this year, I'm not looking for dramatic earnings growth. I think there's downside to the consensus around, I think it's 215 consensus. I think it's downside to about 0 to 3% growth. And it's that slowing of growth and deflationary impulse that really affects the market. I think we're going to have a weak late second into third quarter.
And Barry, I want to go back to a point you made before the break, going back to real yields, because again, looking at the 10-year real yield, negative 18 basis points, that is very not negative compared to what we've been getting used to. And I'd love to hear your perspective on whether it's the direction of travel that matters more than the actual level, or does anything actually change when we hit 0?
Since the late 1980s, 10-year yields have been in a very defined trend on the way down. In fact, they're looking very peakish on that trend right now, the nominal yield. What's lagged quite a bit is the real yield. Even though its trend is deeply down, it has upside. It could go above 0 fairly quickly as the Fed tightens. When that happens, your longer duration, your technology stocks, your tech with no earnings indices, they get hit hard. And that's been happening. So as long as the Fed is tight, I think they're going to drive us into a wall here on the outlook for long-duration equity growth. You're seeing it with shorter cycle capital goods, which is semiconductors. You're seeing it with transports. GDP is going to slow. This is a deflationary wave brewing. And our structure is defensive with a barbell in certain growth that takes advantage of, for instance, the peak of oil, which we think oil is peaking. The switch to services, media and entertainment, retail, and software, because we have a very full employment labor economy, and capital spending for that, or spending for that, is going to continue to be high on software.
Is the labour market overheating? It was interesting, Jan Hatzius was making that point with Goldman. What do you make of the labour market as it stands, Barry, and whether that can be supported, whether we'll get wage inflation, whether the consumer can support some of the retail stocks you think will continue to outperform?
The Conference Board survey looks at wage expectations. So this is people's actual expectations of waves, and that hasn't really soared yet. But, you know, psychology can turn on a dime. So if people start expecting higher wages, then inflation becomes unmoored, and the Fed has really no choice but to bring it all down, probably in a hard landing. That hasn't happened yet. But I do think that we are approaching a point, obviously, of full employment below what's called NAIRU, or non-accelerating inflation rate of unemployment, a very low level of unemployment. And when that happens, when you go too low on the unemployment rate, you get this sort of hockey stick for wages, and that can outpace productivity and drive down margins and create inflation. So, you know, the Fed sees all this, and that's why they're talking exit. But I think by the fourth quarter, with the slowdown in GDP and the slowdown in inflation, they might actually signal a pause, and that would trigger a year-end rally. But we're a long way from year-end right now.
And do you think that that would end up being the right move by the Fed, Barry?
Yeah, because, you know, China is doing some of the work for them. China's growth is slowing. Their COVID strategy has been less than optimal. The effect of the spike in food and energy is affecting consumers. I think that when you get towards the third quarter, as transpos and semis are telling you, you've got a slowdown, and that does some of the Fed's work for it, so the Fed could stop, yes.
And Barry, I was reading over your notes, and one line stuck out to me that we think the Fed almost triggered a 2022 bubble like 1929, like 1999, but that was prevented by its hawkish shifts. Are we completely out of the woods there, or do you still think that there's risk of a bubble?
Well, you know, there's some people who talk about the 1998 parallel where Alan Greenspan cut rates and eased, and you had that final blow-off from October of 98 to March of 2000 in the NASDAQ and the speculative stocks. I don't think this Fed is outright going to signal that kind of pullback where they want to encourage a bubble. I think they're walking a fine line of trying to keep the PE up and not collapse it at a very high level. This is the price earnings multiple of the market. But they're not going to, they're going to be opportunistic on their moves. And so they could pause, just like Janet Yellen paused back in early 2016. She did a pause for 9 months. You know, they could pause, and then that would trigger a rally. But I don't think this Fed wants to cause a bubble. No, not this time.